Bloomberg Audio Studios.
Podcasts, radio, news.
Hello, welcome to the Merryn Talks Money weekly roundup, our debrief on the biggest stories in markets and economics. I'm John Stepek, senior reporter and author of the Money Distilled newsletter, and I'm taking the lead this week while Merryn's out in Japan, you lucky things. But with me is someone arguably just as exciting, that is Marcus Ashworth, Bloomberg Opinion columnist. Hello, Marcus.
Hello, John.
So, Marcus, I was relieved to hear that you could join me today for our chat because I want to talk about your area of expertise, which is the bond market, the mysterious bond market, and all the trouble that it causes for both our own politicians and the world in general. And I thought we'd just have a chat about what's been going on, because one of the things that's happened this week, or that people have noticed this week, and you noticed a while ago, is that UK gilt yields have crossed above the yields on US Treasuries for the first time in quite a while, and it's quite a rare thing to happen. So do you want to explain what that actually means, first of all?
Clearly, the obvious rationale is that the Bank of England has been recalcitrant over lowering interest rates after the Fed's very aggressive, you could call it now, after looking back on those payroll numbers, that they are not going to cut interest rates as quickly as the Fed clearly wants to and has signalled with their 50 basis points move.
Just for context here, so the Federal Reserve, the last time that it cut interest rates, so last month, it cut interest rates by 0.5 percentage point, and everyone was kind of surprised by that. It was a bit punchy. And then the Bank of England had only cut by 0.25 point, and also certainly up until last week, or up until it saw what the Fed had done, Andrew Bailey's been a bit cagey about whether we would cut rates as aggressively. That's basically it?
Yes, though of course in classic Andrew Bailey form, he then completely volte-face and in an article in The Guardian basically talked about being more active and all that sort of good stuff. And then the US non-farm payroll number for the month of September, released at the beginning of October, showed that the fact that the US economy is actually really quite strong, and everyone's gone head faked again. So we're feeling sick. We've been on a roller coaster. We want to get off. But at the moment, the thesis is probably the Federal Reserve will cut interest rates more aggressively, probably, than the Bank of England will. So that's one basis on the gilt market, yielding across the curve largely higher than US Treasuries. Interest rates are not dissimilar as far as official rates concerned. Why are UK yields yielding more? And there's the potential, therefore, of increased supply. And really what we're all worrying about is October 30th, which is what Rachel Reeves' budget will be, and whether or not she increased the gilt remits, how much the government borrows each year, pegged at £278 billion this year. Technically not the largest number ever. However, it is really the biggest number ever because the Bank of England is not buying gilts as it once did. It is now selling gilts. Net. If they increase that number anymore, oh my God, who's going to buy this thing? Therefore, interest rates, overall borrowing, which reflects on all corporates, which is the spread above, it's not good. And I think that's something which I wrote about, as you mentioned, a few weeks back, saying that we knew what happened with Liz Truss in 2022. We're 2 years on from that. Have we learnt the lesson? Well, Labour needs to bear that very much in mind if they rejig the fiscal rules, which broadly I think is probably right to do, but doesn't mean they have to take full advantage of them straight away. If they start increasing borrowing dramatically, we could have another mini type of scare.
To unpack a couple of things there. So, first of all, what you're saying there is, and I think often normal people, if you like, forget this, but the government bond market is a market like any other. The supply matters as much as anything else. And at the moment, as you say, if the government's kind of borrowing more money and therefore having to write more IOUs, and then on top of that, the Bank of England is selling off the IOUs that it was previously buying, then that means the amount of IOUs hitting the market is much bigger.
Like any market, sometimes it doesn't matter. You can sell ever more. In fact, you can't. Please sell more. Sometimes no one who wants anything, and the risk is it's surprise if all of a sudden the Labour government taxes us more, spends more, and also borrows more, all three at the same time, that's a bit of shock and awe, which, where would be the weakest point? We'd all flinch and go, I won't spend as much. And maybe, the economy will take a bit of a shudder. But the first and quickest and nastiest reaction will come from the bond market, because they'll go, hang on a second, you want us to buy more of your debt? Well, we won't, unless you pay us more money for it instantly. And that's what happened with Liz Truss and the mini budget 2 years ago. Instantly there was a shock reaction. So I'm not saying it's going to happen. I hope it doesn't happen. I hope the Treasury and the government have done all their sort of numbers and do this carefully. But it's definitely something, one of the main reasons, not the only reason, why we are charged more for our debt in this country than, say, the US government. That's been happening for a little while. It actually happened as a lead up to the election. I do blame is the wrong word, but the core point here is that the early call of the election, that's exactly when the spread started to move. Borrowing costs rose up in the UK compared to the US. So you cannot not put it on the fact that there's a new government coming in and is expected to borrow more. There's definitely, that's the rationale relatively between the US and us. Whatever the Bank of England does on interest rates is what's a mystery to all of us, including the Bank of England, but we can move back on that in a second. But also at the same point, yields have been dropping in Europe, particularly in Germany, because they're going into a real state of recession, potentially deflationary aspects coming there. So we now look even worse compared to Germany and the rest of Europe as well. So combined effect.
To be fair, though, that's partly because I think this is the other thing that people will possibly, like normal people, might find a bit confusing. At the end of the day, German borrowing costs are going down because the German economy isn't deep.
Yeah, this is the fight to quality.
It's not a good thing.
It's not a good thing. No, yeah.
Aye. And so presumably the contrast between UK and German yields is somewhat more to do with Germany.
I should have emphasised that point. Do not think it's all bad UK.
Yeah.
Quite the reverse in this sense. But nonetheless, who's paying the most to borrow money? It's us. Is that something which could and should pass? Possibly. But a lot of bit of fear and worry coming into the October 30th date. Once that passes, I don't think she'll be able to do anything like what certain newspapers have been scaring us all could possibly happen. But the risk of less taxes on us as individuals is more borrowing on us overall as the taxpayer, and that could be a longer term, much more worrying for us. So keep it in mind.
So there's the actual numbers, but then there's what they're doing this for. So in terms of the credibility, a lot of it presumably is about, is this plan a good one or is it a bad one? Like if they come out and say we're going to stiff all, if it sounds like it's an ideological attempt to stiff the rich, then that will have a worse reaction than if actually we're trying to invest to grow the economy. Is that fair to say?
Well, this is where the burden gets shared. So will it be bang, 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 non-doms get, heavily hit, capital gains tax, it doesn't really matter what it is, but if it's a one-off and they say very clearly, right, that's the poison, take your medicine, we move on. I don't think they're able to do that. I think because they've dragged this out for so long and made this whole October 30th being the it's created a situation now they're going to have to go in increments, and that's almost worse because I think then no one knows that at the end the poison's been taken enough already and we can move on. The bigger risk, as I keep on going back to, is if they increase the borrowing on the government bond market, the gilt market, to soak up what they can't do on taxes, that will affect how much we borrow and how much everything costs. As I said, 278 billion is a large amount of money, but it's only going to increase in the next 2 or 3 years, and it could increase substantially, and that could become, say, unsustainable. We could have a difficult situation where at the start of a new government, that the bond markets are saying no, and that's really what they don't want to go into. So, I'm not saying it's going to happen. I sincerely hope it won't happen, and I hope they're just picking up the spidey senses here to be a little bit careful when they change the fiscal rules, as they're evidently going to go to. And look, the Bank of England's got out of their way a bit. I don't want to get into the very exciting subject of quantitative tightening, i.e. bond sales by the Bank of England, but they have backed off.
Yes.
If the Bank of England cuts interest rates, which they really should, then it will help them, and we can all get over this. And I think October 30th probably will end up being one of those events which aren't anywhere near as worrisome as we built it up to be.
And presumably the other thing is that there isn't the same LDI problem, because Liz Truss blundered into something. It wasn't just because she didn't speak to the OBR. I mean, one reason that, Rachel Reeves has had to delay the budget for so long is so that the OBR will mark her homework, so that there isn't a Liz Truss moment. And that's all theatre.
Well, I don't think we've got time for this. All I can say is that, for what are the many things that Liz Truss can be blamed for, and I think the 5 words from Kwasi Kwarteng, there will be, basically there's going to be more coming, was the biggest thing. The LDA crisis wasn't necessarily one you can blame, at her. But as someone said, you walk into a shed of fireworks with a lit match, that's what you get. So and the shed and the fireworks are no longer there, nor a Liz Truss. But, at that same point, I think, really at that point, there are lessons to be learned 2 years on. Be careful with the fact that our borrowing costs have already moved, should we say, 50 basis points wider than they were before we knew Labour was going to, soon come into power. And, this will work its way through. If it's handled and managed properly, I'm sure we'll just view this as a little of a blip, and therefore gilts are theoretically cheap. But at the moment, they're cheap, and they're cheap for a reason.
Fair enough. On the actual budget itself, we've been talking a lot about the stuff that might hit investors' pockets over in the podcast over the last few weeks. In terms of pensions specifically, the various measures that they're talking there, is there anything that stands out to you as something that seems likely to happen or unlikely to happen?
I think you have to think fairness. We've got a Labour government, all right? What does socialism, whatever we get too pejorative in the term, but what does it mean? It means that we should be socially fair. Is it right that a pension, and I appreciate there's different defined benefits, die with the defined contributions at the moment carry forward and are not part of an individual's estate? Should that be the case? Probably not. I expect them to put them back into everyone's estate in that sense. Will they reduce the amount of annual allowance, which is currently recently raised up to 60,000, back down again? Again, I would think that's sensible. Probably they were bungs from the previous government, which we certain things they can reverse. The scrapping the lifetime allowance they can't. There's a number of things they'll find very tricky to do. Would they reduce the amount of tax benefit we get off of higher rate tax from 45% down to something close to 30? Again, I could argue that very clearly as being fair. Why should a 20% taxpayer not get as much benefit as a 40 or 45%? That doesn't, in egalitarian sense. So I think they'll probably do things like that.
But the tricky thing with that one is that it hits the public sector.
Why?
As well.
Doesn't.
Oh no, it does. Because the tax relief side of things on a DB pension, if you everyone gets treated equally. It doesn't. That's the one I'm talking about equality here. Oh no, but what I mean is, if you end up, put it this way, it's one thing to say you're going to take it away from private sector workers, but you're setting yourself up for a massive
fight. They can't be quite
fight.
that blatant. Yes, they are backed by the unions. They are paid by the unions in many, many ways. And yes, the public sector unions are the most powerful, but they can't be quite that blatant, surely.
I'm impressed with your faith.
Because if you say they're going to do that, then what's the point?
But the annual allowance was all changed largely because surgeons and doctors were complaining about having to leave for various reasons, and that was all
a bad
up.
fix, which I think they were over. Look, pensions
what I'm saying is, do they really want pick another fight with the nurses and the doctors? Do
they want to pick a fight with the rest of the world, the rest of the economy, the private sector? I don't think so either.
I'll be interested to see what happens. I'm interested to see what happens.
Public sector pensions are notoriously hugely generous. Reducing the amount that the higher rate taxpayers get down to a lower level to equate them with lower rate taxpayers, I would say would be fair. And they could get away with that. They could justify that rightly. Right. Certain things which I think they'll have real problems with, for instance, lowering the amount that you can get as a tax-free cash sum, which is currently 268,000. It's a random number which hasn't changed for a long while. It was a quarter of what was the old lifetime allowance. I think, again, that's breaching people's trust. When you created a pension, you put all your money into it, you always banked on having a quarter of that tax-free to pay off a residual mortgage or whatever it may be. To take that away, I think would be retroactive, respectively, egregiously unfair, and I really hope they won't do that, because that couldn't be justified, I don't think, in any sense of egalitarian form. So, do I think they'll raise capital gains tax? Perhaps to square away a little bit with private equity's carried interest, which is currently taxed at the top rate of capital gains tax at around 28. Should it be 45? Well, yes, we all know it should be 45, but can you do it in one big step? No. Could they move the capital gains tax and match that with where carried interest get? Yes, probably. I can see them doing things like that. But they've got to be careful on doing too much too soon. The tax code in the UK is obviously extremely complex, and the knock-on unintended consequences here are vast. So there's certain things I can do. They could argue, I think, in an egalitarian, fair way, most people who are getting 40% tax relief on their pension only getting 33%, will they stop putting money in their pension? Of course they won't. So I think that's probably what they'll end up doing. Common sense, I hope.
That's a fascinating one. That is a fascinating one. Anyway, thank you very much, Marcus. Thanks for listening to this week's Merryn Talks Money debrief with me, John. If you like our show, rate, review and subscribe wherever you listen to podcasts, as long as it's a 5-star review. Also be sure to follow me and Marcus on X or Twitter. I'm at John_Stepek and Marcus is at Marcus Ashworth. And also follow Merryn at Merryn SW. This episode was produced by Summer Sadie, production support and sound design by Moses Andam. Questions and comments on the show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net. So please send in all your queries and any questions you want answered for the Personal Finance Podcast.